Thank you. Good afternoon, everyone. I'm Novia Chen from the University of Houston. I want to first disclose that I am an accountant. So any qualifications in the room? Oh, no? Okay, so just what I expected. But I'm very happy to be here, and many thanks to the organizers for including our paper in the program. And so this is actually my first paper that looks at anything that's related to household finance, because as an accountant, I deal with corporations like with financial reporting data most of the time. So I am a tax accountant, but most of the time I'm dealing with tax planning of large multinational corporations. So this is really my first project that looks at individual level tax and financial decisions. And so this paper is co-authored with John Kim from Singapore Management, and then Novia and Chen. They're both from UC Irvine, and actually all four of us are accountants. So in this study, we look at income tax over-withholding and how does that affect individuals' investment decisions. So a little bit of background very quickly. So in the United States, the individual income tax was remitted on a pay-as-you-go system. So if you are a wage earner, then every month or every 2 weeks when you receive your paycheck, your employer would withhold taxes and remit your taxes to a tax authority for you. And then if you're self-employed, you have your own business, then you're required to make estimated tax payments every quarter. But that's not the end of the story, because at the end of the year, after the fiscal year has concluded, most individual taxpayers are required to file a tax return, so in which they'll incorporate more information like the gross income or deductions to calculate their final tax liability. And then in the ideal situation, of course, is that you have break even, right? So what you have already remitted is the same as your actual tax liability, but that's not the case. So a stylized fact is that many U.S. households, they over-withhold their taxes. So 3/4 of taxpayers, they actually receive a tax refund during the tax filing season when they file their taxes. So, and then the tax refunds are actually pretty sizable. So this is data from Farrell et al. 2019. They're with JP Morgan. So they use their customers' data, so they figure out that it's about $3,600 average tax refund, so that represents about 6 weeks of take-home pay for the taxpayers receiving tax refund. So it's pretty pervasive and sizable. So our research question is, we want to examine how does this over-withholding affect American households' investment in the stock market. So our motivation is twofold. First, the rate of stock market participation is still relatively low. So based on and by the way, I learned about life cycle model last year when I was doing literature review for this project. But based on the life cycle model and portfolio choice, every household should invest a positive fraction of their wealth in the stock market, right? So we should see every household, no matter how wealthy or poor they are, they should be exposed to the stock market. But the rate of participation is about 53%, and it's even lower among low-income households. And the personal savings rate is also relatively low. It's hovering around 4 to 7% during the last 10, 15 years. Another motivation for our city is that tax policy has long been used to promote savings and investment. There's typically implemented in 2 ways. First, there is tax deferral for certain investment or savings vehicles. In the U.S., we have the 401k, where you receive deferral on your contribution, so you only pay tax when you retire and take withdrawals from the accounts. And similarly, individual retirement accounts provides the deferral benefit. So that's one. And on the other hand, the tax law allows relatively favorable rates on some kind of investment income. So for example, capital gains and dividend income, they both receive a relatively low rate. And but this feature of withholding has not been explored, has not yet been explored, so that's why we're interested in seeing whether this feature also has any implications for investment. So income tax withholding, why do we see 3/4 of people over-withhold taxes and they receive a refund at the end of the year? First, it's just a feature of the tax system. So we have asymmetric cost of over versus under-withholding. Okay, so over-withholding is not ideal in the sense that you're basically extending an interest-free loan to the government. Okay? But under-withholding, what happens if you're under-withheld? You didn't pay enough taxes. At the end of the year, you find out that you underpaid, so there's a tax payment due. And if you underpay too much, then in addition to your tax payment, you also need to pay a penalty and associated interest. So the cost is higher if people under-withhold. So this combined with other factors such as uncertainty of income, right? So sometimes it's just difficult for taxpayers to predict what their annual taxable income is. So people can kind of err on the side of caution and over-withhold. There are also other explanations, for example, inertia. So inertia happens when people just rely on this default situation. So for example, if I enter a new job, the HR will ask me to file a Form W-4, then I'll tick a few boxes to let people know, hey, I have 3 allowances to claim. And going forward, even if my tax burden goes down, I just don't have enough incentive to go back to the HR to update my W-4. Okay, so that's inertia. And Jones, 2012, he actually showed that he found more of this evidence of inertia for people with a decline in their tax liabilities. Okay, so over-withholding, people receive a tax refund, but it's not free money from the government, right? So it's really just your earned wage income, but now comes later and carries a different label called tax refund. So how do we expect this over-withholding to affect people's investment decision? We have reasons to expect that it doesn't matter at all, because it just simply shifts the label and the timing of income, and money is fungible, so therefore, absent time of value of money considerations, people really are not expected to treat refunds versus wages differently. Okay, so they should invest or consume them in a similar fashion, so that would indicate that their investment behavior should not differ for wages and tax refunds. We also have reasons to expect that the investment propensity would be lower for tax refund. So tax refund, as I mentioned earlier, they're just technically people's earned income, right? But they will appear like windfall gains to some people because of mental accounting or some other type of behavioral bias. They will appear like windfall gains because it's a lump sum amount. It occurs infrequently, and also it is from the government, right? So there are reasons people might view tax refund differently from wages. And there are earlier research arguing that people are more inclined to consume windfall gains. They might consume windfall gains on purposes that they would otherwise not spend money on. And on the other hand, for wages, it's regular, it's predictable, so therefore it's more natural for people to incorporate wages in their budgeting and decision-making process. Okay, so wages might facilitate, for example, automatic investment plans, right? So every 2 weeks or every month, I'll invest a certain fraction of my wage. I'll save and invest a certain fraction of my wage. Well, investing refunds, it requires an intentional effort, right? And maybe an extra layer of self-discipline. And we also have some reasons to expect that the investment propensity out of refunds might actually be higher. I think earlier, Katia mentioned the mental accounting, the 3 mental accounts by Scheffling and Thaler. That's really helpful. We're going to use their framework as well. So Scheffling and Thaler mentioned that there are 3 mental accounts that people would maintain. Current income, that's your regular wage income that comes in every month or every 2 weeks. And then current asset. Current asset, for example, like a large one-time windfall gain will enter the current asset account. Okay? and refund similarly will enter the current asset account. So when an inflow of money enters the current asset account, then people tend to maybe spend some of it and then save some of it. So the baseline is that the rate of saving will be higher for any funds that flow into your current asset account. So that would indicate that people will be more likely to save their tax refunds. And also, if we think about people's budgeting decision, like I need to benchmark my consumption against my regular wage income, right? So I live, let's say, there's a saying that we should live below our means, right? So if that we have a regular wage income, then my usual consumption, like routine consumption, is benchmarked against that. And then when I have a sudden inflow of tax refunds, the immediacy of consumption pressure diminishes, right? Because it's like all of a sudden I have this money that I don't have to use it to pay for utility or to pay for rent. So there is a larger latitude of what I can do with this money. So then because of this decrease in the consumption pressure, people might be more able to save or invest tax refunds. So that predicts a higher investment propensity out of tax refunds. So to answer our questions, we utilize data from a vendor that partners with a few major financial institutions. So this is another thing, a good thing about presenting at this workshop. So I presented this paper to my colleagues at the accounting department at my university, and they're all amazed by this data set, saying things like, wow, you can actually observe people's transaction level data, like how much they paid to a certain merchant or how much or where they get their money from. They're all amazed by it. And today, when I'm sitting in the audience, like listening to all the presentations, it seems that in economics or finance, that's like a state-of-the-art thing, right? So it's really cool to see all those interesting data sets. So we have this transaction level bank account and credit card data. And so this data is very similar to what you see on your bank statement. So for every transaction, we know the date, the amount, the direction, and most importantly, we see the counterparty and a brief description of the transaction. So with all these details, we're able to identify tax refunds. Tax refunds is basically refund received from the IRS. We're also able to identify wages. These are direct deposits from employers. And how do we measure stock investments? So for stock investments, we measure them using net flows. So basically outflow minus inflow. Net flows into brokerage accounts. And so a caveat here is that we're only able to measure flow of funds, but we're not able to observe within the brokerage account how people allocate their investment. So we don't know if they actually invest in stocks or they're just holding this money in their brokerage account waiting for investment opportunities. So that is a caveat. So overall, we have about 3 million individual years covering an 8-year period. So a preview of our main findings. So we find that the investment propensity out of tax refunds is lower than out of wages. So people are less likely or invest less of their tax refunds. As a first baseline result, we do find that taxpayers invest tax refunds. They do invest, they just invest a smaller percentage of it. So our main finding I just summarized, and this finding of a lower propensity to invest tax refunds cannot really be fully explained by the uncertainty of tax refunds, timing differences between refunds and wages, as well as transaction cost. Okay, so we interpret this finding as suggesting that people display some kind of mental accounting, so they just somehow view tax refunds as a different type of money compared to wages. And then we also explore 2 cross-sectional results. One is that wage, because it's regular nature, kind of better facilitates automatic investment setup, so that's why we see more investment out of wages. And financial sophistication. So for financially more sophisticated individuals, they're better able to counter this mental accounting bias. So therefore, for these individuals, the disparity between their investment propensity decreases. Yes?
When, at which time of the year do people receive the tax refunds in the US?
So the vast majority of refunds are received in February, March, and April.
So there's no, oh God, Christmas was expensive, I'm going to use this to offset my big holiday expenditure.
No, individual taxpayers, they're all calendar year. So by Christmas, yeah.
But when do you have to make the return, the claims? When do
You file tax return by April 15th.
Okay. And then,
Yeah. And then I think there is a service called tax refund loan. You can apply for a tax refund loan, and then you have access to that money, and then once you receive your actual tax refund, you repay your lender. But I could be wrong, but my understanding is that you get that loan like after you file your tax return, so you know how much tax refund you're going to receive, and then that loan becomes available. But yeah, usually not around holiday season. Yeah. Okay, so here's our example, and we restrict our observations to individuals with one tax refund in a calendar year. Okay, so individuals who make tax payments, or individuals with multiple tax refunds for some reason, they're not in our sample. And we have two samples for our test. First, for the benchmark case, we only look at tax refunds. And then for our main question, we further require those individuals to also have regular wage receipt. So that's our wage versus refund subsample. So some key descriptive statistics of our sample. So across both the refund sample and the wage versus refund sample, the average refund is about $2,600. And earlier I said the other study showed about $3,600, which is, by the way, also the IRS data. IRS data shows that average refund should be $3,600. So we try to dig into why there's that discrepancy of $1,000. One reason could be that we follow the prior study and we exclude any refunds greater than $10,000 because these might represent some kind of unusual tax circumstances. If we include those refunds back to our sample, the average tax refund in our sample is indeed $3,600. So it's representative in that sense. And then we also looked at the amount of wage. So in our sample, we're only able to observe after-tax wage because that's the money that flows into their bank account. So analyzed after-tax wage in our sample is $51,000. We need to kind of convert that to a pre-tax basis. So assuming, let's say, this person is married, filing jointly, so on a pre-tax level, this is about $75,000 to $79,000. And the Bureau of Labor Statistics report a median pre-tax wage of about $60,000. So it does seem like the average individual in our sample received a little bit higher wage compared to the average, which is not too surprising because our sample focused on individuals with bank accounts, right? Because there are also unbanked individuals. Yeah.
Is there a special reason why you want to go weekly level?
Huh?
You compute your observations at the week level, right?
Yeah.
Is there a special reason why you do it at the weekly level
rather than
monthly?
So our wage is, we're trying to include both bi-weekly wages and monthly wages.
Yes.
Yeah, so if we do a weekly level, so we're able to include the bi-weekly wages. So we can look at investments during the week after and then compare it to the week before. If we look at investment, if we structure our data at the individual month level, then we're not able to include the bi-weekly wages.
Okay. But folks who are paid monthly will have 3 weeks in which income for them is zero.
Sorry?
Folks who are paid monthly will have 3 weeks in which the
Oh,
they make
oh,
zero.
yeah, so maybe I was not clear. So we will only include the week they received the wage, and then we include the week prior to that. So
Okay.
there is not going to be a week where the wage variable is zero.
Okay.
Okay, so here is more descriptives, but broken down into state level. So basically, in our sample, the tax refund size is either very similar to the IRS data or slightly lower. Okay, so here is our benchmark case where we only include tax refunds. So for now, we're not requiring the individuals to have wage information. So we're just looking at tax refunds because we think this piece of evidence is just interesting on its own. So we include 53 weeks of data, so 26 weeks before tax refund, and then the week of tax refund, and then 26 weeks after. And so these are all event weeks. Okay, so week 0 is the week starting on the day of tax refund receipt. So what we are interested in here is the coefficient on the interaction term between tax refund and post. That post is our event week indicator. So a key takeaway from this figure is that people promptly invest their tax refunds. Okay, so in the first week they receive this tax refund. And there's not much of a pre-trend, so it's not like I anticipate I'm going to receive a tax refund, so I started investing now. So there's not much evidence of pre-trend, and there is also not a lot of delayed response. So we repeat this analysis in our main test sample, so here we further require the individual to have wage information. The trend, the pattern is similar. Okay, and so this table just summarizes what you have just seen in the figures. Yes?
So, could you go back to the previous slide? I'm just trying to understand, so the x-axis are weeks or days?
Weeks.
They're weeks.
Mm-hmm.
And so, but people get wages, say, every 2 weeks or every 4 weeks.
Mm-hmm.
Why isn't it spiking every 4 weeks?
Oh, so this is just regressing the investment amount on tax refunds and its
Oh, this is tax
interaction
refund,
with-
I thought this was...
Yeah, so we're just
Okay.
trying to use this to establish a baseline case in terms like how people, to characterize how people invest tax refunds. So wage is not in our analysis just yet. Okay. So this table just summarizes the coefficients in the figure. Okay, so that's a benchmark case, which it's helpful in the sense that we know that people promptly invest tax refunds. Now we want to answer our main question of, does this propensity to invest differ across wages and tax refunds? So to do this, because wage arrives very frequently during the year, so we cannot use that long 53-week testing window anymore. So in this test, we use a 2-week window centered around the date of wage receipt or refund receipt. Okay, so basically we want to see during the week after you receive wage, what is your incremental investment, and what is the percentage of that incremental investment as a percentage of wages, and then we do the similar regression for tax refunds. So the reason why we focus on this 2-week testing period is that wages could either arrive biweekly or monthly, so we do a 2-week period to take advantage of a larger sample size, because we're able to include both biweekly and monthly wages. If we instead use a 4-week testing period and only use monthly wages, we do find similar results. But for the result that's presented, we're using 2-week testing window. And our earlier tax refund analysis suggests that investment spike occurs pretty quickly. So we think that using a 2-week window is going to capture the vast majority of investment response to tax refunds already. Okay, so here's our main result. So for the first column, so that's the incremental investment response to wages. We see that the coefficient of wage times post is 0.041, so that means people make an incremental investment during the week after wage arrival. That represents about 4.1% of their wage amount. And then if we repeat the same regression for tax refunds, this percentage is 2.8%. Okay, so people display a larger propensity to invest their wages. Okay, so there are several possible explanations that we would like to explore. Some of them were raised by our workshop participants earlier. So first is tax refunds are more uncertain, right? So if you're faced with a fund that is uncertain, that kind of may diminish your investment response to that money. So for this uncertainty explanation, we did two things. And by the way, so all the tests that I will describe on the slide there, I did not tabulate them because some of them we worked on these tests last month. So when we sent the paper to the discussant, it's not in the paper. So I just feel like I'll just describe them as untabulated. Okay, so we looked at individuals who received similar refunds over the past 2 to 3 years. So individuals who consistently, let's say, received $3,000 refunds in the past 2 to 3 years. In that subsample, we continue to find a larger propensity to invest wage. And in another test, we looked at tax filing date. Because when we say there's larger uncertainty around tax refund, but that uncertainty should be resolved when people file the tax returns. When you file tax returns, you know how much tax refund you're going to receive, unless you make a mistake, right? You know how much tax refund you're going to receive. And if you use tax preparation services like TurboTax, right? When I complete my tax return, it will send my tax return to the IRS and tell me you can expect a tax return in like 21 days. Okay, so a lot of uncertainty would have been resolved by the time people file the tax return. And we are able to guess the tax return filing date for people who use tax preparation services. It's like, let's say, April 1st, I saw this individual paying $70 to TurboTax, and that's the date this individual filed the tax return. And we don't see any discernible investment response around that tax filing date, which is when the uncertainty is resolved, we don't see any investment response. And another possible explanation is that there are tiny differences, like you raised earlier. Refunds are concentrated in February, March, and April, while wage can be received throughout the year. And then if we think in the sense of a fiscal year, even though I don't understand, like if we're using a life cycle model, fully rational individuals should not put artificial cutoff to their fiscal years. But even if we think in terms of fiscal years, right, wage arrive earlier so that you have more opportunity to invest wages early on, and refunds occur later, so that kind of may explain why people are not investing refunds. So to address this possibility, we look at investments around wages and refunds that are received within a similar time frame. So that's within 30 days of each other, but 15 days apart. Okay, we still see this larger propensity to invest wages. And the third possible explanation is transaction cost. Okay, so for transaction cost, we think it should not really affect our setting because when we select our sample, we condition this individual must have made at least one brokerage firm transfer in the prior year. So these are people who already have brokerage accounts and who have recently contributed money to the brokerage accounts. But to further address this possibility, we restrict to active investors, i.e. those people who do invest after tax refunds and after receiving wages. Okay, so for these people, it's not a matter of whether I invest or not because they all invested. Now it's more, so now this test really focuses on this intensive margin, right? So we invested, but how much do we invest out of wages versus tax refund? And we still find that people invest more out of their wages. So And with all that, we're kind of leaning towards maybe a behavioral explanation, like people just somehow view tax refunds differently from wages, so they invest them differently. So in the next two tests, we're trying to look at some cross-sectional variation or mechanisms that explain why people invest more out of wages. First is automatic investment setups. Okay, because wage is regular, so it just naturally facilitates automatic investment, while refund, not so much. Right? So for refund, you really have to call your bank or now, like at least take out your phone, open the app to invest for refunds. So to identify people that have automatic investment setups, we identify individuals who make between 11 and 13. These are like monthly investors, or between 22 and 27, so these are bi-weekly. So we identify these people that regularly contribute funds into their brokerage accounts, and we label them as the people with automatic investment setups. And what we see here is, so for people with auto transfers, like with automatic investments, they invest more out of wages, which is consistent with wages kind of facilitating automatic investments. And, but there's no difference for tax refunds. And then another cross-sectional variation that we explored is financial sophistication, because if we indeed view what we observe as kind of representing a behavioral bias, then financially sophisticated individuals should be in a better position to counter that bias. So to measure financial sophistication, unfortunately, we don't have an individual level measure because all we observe is from the bank statement, and so we don't have a lot of demographic data on that. So what we do is we look at zip code level, financial literacy, and level of education, and we assign individuals to these zip codes based on where they shop. So this is zip code level measure. And for financial literacy, we find that individuals who live in areas with higher financial literacy, they invest more out of their tax refunds. So the disparity between investment propensity will be smaller because now they invest more of their refunds. And similarly, if we measure financial sophistication using the percentage of population that has a bachelor's degree, we find a similar result. So the college education, this indicator increases the propensity to invest out of refunds to a larger extent. Okay, so yet more alternative explanations that we're trying to explore. First is when we were just talking about this project, Michael also said, I don't invest my tax refunds because I don't even care. Like when it arrives, like I have no idea. Of course, like he's a professor, so you can know why he doesn't care. But awareness is something that we thought, okay, maybe interesting to explore. So if people don't invest tax refunds because simply they're just not aware of its arrival, then they should also not consume of it. So that's why we look at a different outcome variable here. We look at total consumption. So for total consumption, we find that actually the propensity to consume is comparable between wages and refunds. So people consume refunds in a similar degree compared to wages. And total consumption includes more routine type of transactions, such as mortgage, not mortgage, but such as a utility, right, rent payment that you will budget against the timing of your wage income. So we also try to exclude those routine transactions and focus on discretionary consumption. So these will be things like vacation, if somebody buys electronics, entertainment. And what we find here is that people are actually consuming more out of their tax refunds for these discretionary consumption categories. Okay, so this is really inconsistent with this awareness explanation. Yes?
So does it mean that they're consuming 8% of their refund and 7% of their wage? Is it what
So they their incremental consumption during the week after receipt is 8% of refunds.
Okay, because I'm thinking if only 4% of refunds goes to the brokerage and only 8% goes to consumption, then it looks like they're using a lot of the refund to repay debt. And repaying debt now makes sure that with my future, so I get my refund, I repay my debt, and with my future paychecks, I will basically be able to save every week or every 2 weeks.
Yeah.
And so am I not saving through my refund by avoiding the liquidity strain that not doing it now would imply on my future income?
Yeah, excellent point. So we also looked at debt repayment, and so the propensity to use wage to repay debt is greater than that of refund. So they are using refund to pay down debt, but to a smaller extent compared to how much they're using out of wages to pay down debt. Does that address your?
Yeah, I still don't know where the money goes.
Huh?
I still don't know where the money goes.
Oh, so because the consumption here is only 1 week. Yeah, that's just due to the nature of our data. We include. So unlike prior studies that examines consumption responses to tax refunds, they can use a much longer period to examine that. But here, because we need to benchmark toward wages, so it's a much shorter period. Yeah. So it's still possible that for tax refunds, maybe for investment is probably more of a one-shot thing, right? I invest this amount, but consumption it could happen over time. Yeah, so it could be greater than that 8%. Yeah.
When you started presenting, I was wondering why you focus on investment decisions and not on consumption or credit card repayments, and I guess because the results aren't very strong, that's why it's not giving enough.
Well, no, we wanted to look at stock market response just because we're accountants, so we just feel like that's more, that's like the first thing that we can think of. It's just while we're working on the project, when we're trying to figure out other, like where did the money go, like other alternative explanations, that's when we started to think about
a household balance sheet, the main form of saving is housing. So like most of our savings is in the form of housing. And then we have a lot of stock market investment in our retirement and our pension funds. So is it really we need more stock market? Like when you, because in the 401ks they have stock market investment. So there's other outcome measures.
Yeah, I think that kind of depends on how you view like a 2.8% investment rate out of refunds. I'm not saying that it's high or low, but it's lower than wages. Yeah, I think that's the, I'm not able to like tell you whether I think that is too high or too low. Yeah.
So I'm wondering, I think it's outside the scope of your data, but I'm wondering where the tax refund comes from. So you could imagine that some of that tax refund is from people contributing to IRAs that are tax deductible, and at the end of the year you're getting a refund, and maybe like these automatic enrollers are just putting money in the IRA every 2 weeks, they get a big tax refund, and they kind of feel like they can spend it on something else because they've saved throughout the year.
Yeah, it could be, like for deductible IRAs, yeah.
So is there a way for you to know where the tax refund comes from? Like, do you have a sense just in general?
We thought that for a lot of wage earners, that's they probably contribute more to 401k as compared to IRAs because it's like you only have 6,000 per year. But we should, because that's a like personal level discretionary decision. You contribute out of your after-tax wage to IRAs. Yeah, that could be something that we can observe.
You get a big refund.
Maybe just following up on that point. There's this paper by Gelman, Shapiro, and Porter at the AER, and their point is a lot of the variation in these tax refunds comes from having lower income than expected. So if you're hit by bad income, your income was lower than you expected, then you get a higher refund because you over contributed, but that also means that you're more likely to be liquidity constrained. So you'll have a higher marginal propensity to consume, you'll be less likely to invest because it's correlated with having a bad income shock.
Yeah.
So that could be, yeah. consistent with this.
So I'm not trying to like just for the sake of defending myself, but if people are liquidity constrained, now they will use any funds that they receive for consumption purposes. That does not explain why they're investing more out of their wages. I still kind of, it's...
I think it is that the valuation of the refund is correlated with these shocks, whereas the valuation of wages is not correlated with having bad negative income shocks. Right? I mean, if the people getting bigger refunds are potentially those who were hit by the bad income shocks, whereas people getting wages, that's just not correlated with that, and so...
Okay,
That
yeah.
I'll show that in the discussion as well.
Thank you.
Everybody's taking what I had to say.
Yes.
Yeah, just one more suggestion in line to test for liquidity constraints is you can look at the response of wages in months where the refund comes versus the response of wages in months where the refund doesn't come. If there's no liquidity constraint, then they should be just doing their automatic thing no matter whether the
So
refund
you
comes
should
or
not
not.
differ if they're not
Yes.
constrained. Yeah.
If when the refund comes and they invest out of the refund, which is what you're calling it, they decrease how much they invest out of the wage, then perhaps the liquidity constraint is binding and you need to choose. I can only put $200 aside,
Yeah,
no matter.
Yeah, we can definitely do that. Right now, we just compare, we looked at when the two are close to each other, but we did not compare between wages received in different months.
Yes.
So that's something we can definitely do. So I'm running out of time, so I guess I'll skip the robustness test, and for our key takeaway is really people view these two different sources of income differently. Well, they technically should not, and they're more, that's more out of wages. And there's extensive literature that looks at consumption responses to income shocks such as tax refunds or tax rebates. Investment behavior is relatively understudied, and there's also a large literature that examines favorable tax rates or savings vehicles. How does that affect people's investment behavior? But this withholding feature has not been explored before, which I think we contribute along those two dimensions. So implications, if there's one takeaway, we think that it kind of speaks to the role of behavioral factors in formulating tax policy design. So if people view the two funds differently, maybe a more neutral withholding scheme that allows people to have a little bit more take-home pay every month, that might actually lead to overall higher stock investment, if that is the policy objective of policymakers. So with that, I would like to conclude. So I've left that email here. So welcome any comments or suggestions. I'm looking forward to their discussion.
Thank you.
How is that on volume? Can you hear me okay? I'm sorry, I'm losing my voice, so I requested double palm mic. Just give me a point up in the back if at any point I start trailing. So first and foremost, thank you very much for the invitation to be here. I always love coming down and discussing at this conference. Wonderful presentations in general so far today. I'm delighted to be here. And especially to talk about this paper because income tax over-withholding is something that I've worked on as well. And I think it's quite interesting from a behavioral perspective, kind of an opportunity to study behavioral economics in the tax code. So just very quickly to recap, and I think we just saw it, but I'll just sort of reiterate, consumer bank transactions, we observed line items on those bank statements, and I don't think you really emphasized how much cleaning and analysis probably went into actually scraping the data. It was quite remarkable when you were describing in the paper how time-consuming that must have been, so really impressive there as well. And generally what they're finding is the marginal propensity to save out of wage is about, give or take, rounding to 2 times what it is out of the tax refunds. Fairly robust finding, and there's this cool little part here as well, I think, where it's this correlation with financial literacy in the region, which is kind of nice as well. Okay, so what are the key strengths? Obviously incredible data, a well-defined research question, sensible findings, and incredible data. Okay, I really had to emphasize that because yes, maybe by the standards of the presentations in this room today, you're on par, but in general, within economic science or any discipline for that matter, this is phenomenal data. These are phenomenal data, so congratulations for acquiring that and all the work that went into it. Okay, so I only have one thing to say, and I think it's what's kind of coming from the room at the end of this presentation, so I'm going to save it to the end. But since I've come all this way and I've got 10 minutes, let me just say a couple of other things first. Okay, so if we think about this in terms of a model specification, when we're dealing with this kind of, smooth distribution, large spike at a particular point and then smooth after, the non-parametric estimation makes sense, right? You don't worry about parametrizing it and estimating the counterfactual. You just go right to what is the spike at that point. So we can put together a bunch of these, these fixed effects. We just take the continuous running variable and we bin them, and then we put the fixed effects for each bin, and then we just look at what is that point estimate at that particular point, and that gives us a sense of the magnitude of the change. And if we want to do this in terms of like a pass-through, then we can scale it. So that's what the multiplication is with the refund, is you're scaling it. It's just giving you a sense of what that pass-through is. Okay, you've got multiple time periods, so you can put the week fixed effect, because the timing of the reform is different from the timing of the calendar year. So you can put these week fixed effects in there, and because you have multiple years of data, you can also put the individual fixed effects. Where I started to get confused is the rest of the specification looks like a diff and diff. Right? How are you separately identifying the interaction from these other post indicators when this is really just a scalar within year? This is the specification that's consistent in an event study framework when you have a control group. There's no control group here. So my guess is State is probably dropping, or whatever software you're using, is dropping some of the individual fixed effects and giving your other point estimates for these coefficients, but I'm not sure that they really mean something. I just double check that specification. And similarly in here, this is a specification from a diff and diff. There's no control group. So either I'm misunderstanding something, I'm just not quite clear where the identification is coming from, or the paper could just probably have a little bit more information in there. But it's not entirely clear to me what's going on. And in this kind of environment where there's repeat, it's an environment where you're getting treated, and the next year you're treated, and the next year you're treated. That kind of specification in a diff and diff setting is also a little strange. So I'm just, I would just sort of default back to that non-parametric specification, just leave it at that. And I think that's really clean, and the rest of it is just complicated. Okay. In terms of the interpretation, I just wanted to emphasize you're not paying off all your Christmas shopping, you're barely affording the turkey that you served, right? It's a $67 increase in terms of the savings that's going into there. So I think if you're trying to map this into a policy implication, the scalability of this would be something I would want to focus on. And I don't think you really emphasized, you focus on savings rates, because that's where you see the difference. But when you map this into a dollar value, it's really not all that substantive. And I think that part of the paper needs to be clear as well. What was also a little strange for me is you modeled your wage analysis around the pattern that you saw in your refunds analysis, but in wages it's a continual flow of funds. So if I have spikes in my savings that look like this, or spikes in my savings that look like this, really it's the total pass-through of my wages into savings that matters. It's not just the spikes that occur at the time of the income receipt. So I'd be a little bit concerned about interpreting that wage analysis as being really informative in terms of a comparative sense. Okay, going further, this is a paper by Rees-Jones, which I would encourage you to cite, because it's a really nice paper that actually looks at using IRS data, the distribution of refunds in the U.S. And you can see that there's a lot of heterogeneity there. And I think your analysis is really focused on that average treatment to treat, like the ATT. I'd be really interested in knowing more about the heterogeneity here. So what are the dynamics of refund receipt? How do people differ by their location in the distribution? How does the marginal propensity to save out of the refund vary with that heterogeneity? Like there's so much you could do in terms of heterogeneity, given the richness of the data and the work that you did to construct this data set. I would really lean into that and produce disaggregated statistics. So looking beyond the average treatment on the treated, what can we say about behavior for subgroups of people? That disaggregated statistics approach I think is becoming really, really relevant now. Okay, so the last thing I want to say, and this is what was coming up in terms of the questions that we saw at the end, was your tax refund is a choice variable. And so that Rees-Jones paper shows that for people at the bottom of the income distribution, there's really not a lot of tax manipulation at the zero balance threshold. There's not a lot of tax manipulation. There's not a lot of sorting there. But when you get into the higher income distribution, there's a lot of sorting. There's a lot of exploitation of tax avoidance mechanisms, including IRAs, to be able to be at that threshold. And so if we think about this in terms of a manipulation or a choice variable, it's really not surprising then that the refunds would be different. The marginal propensity to save at a refund would be different, because ultimately they're doing something to get there in the first place. And one of the things that, and excuse me, this is a little bit of a self-plug here, but it is a published paper. Given the audience, I've chosen to emphasize the working paper, which I think is probably a safe bet, right? There's a paper out of, by a lowly economist at Memorial University who studies the effects of the contributions into the equivalent of IRAs in Canada, the registered retirement savings plans, and shows that there's this increase in the use of registered retirement savings plans, or the IRA equivalent, to be able to get down to that threshold. So tax-deductible savings plans are indeed one of these ways that people are manipulating their balances and getting down to that zero threshold. So it seems plausible that you would arrive at that result because savings from wages were used to produce that result. So they're not going to turn around and put more money into savings. They've already done that to get there. And in fact, in this paper, I do have linked financial literacy data at the individual level, and I show that it's the lower financial literacy people who are driving that. So it's really, I think, the exact mirror image of what you're finding and would perfectly explain your heterogeneity. Okay? So I would also encourage you to take a look at this paper by Naomi Feldman, Mental Accounting Effects of the Income Tax Shifting, where there was a 1992 decrease in withholding rates. The idea at the time was President Bush wanted to stimulate the economy by changing withholding rates, lowering it, allowing people to have more money throughout the year to spend, but not actually change their total tax bills. So it's a really unique reform where they were trying to implement this. And Naomi Feldman studies the effect of that and actually finds the exact opposite results that you do. Where there's exogenous variation in the withholding, the results are contrary to what you're finding. So I really think if you're going to sell this story, this behavioral kind of mental accounting issue, I think you really need to lean into causality. So ultimately what I'll say is it's a really nice paper, it's really nice data. I would lean more into emphasis on causality if I wanted to sell that behavioral story, and I would emphasize more disaggregation as well. Okay? And there's the references, so thank you. Thanks.
So I have 6 minutes, so I just want to say that a lot of really great comments, and thank you so much for the suggestions about alternative explanations, and I really like the IRA one, so that's like the one real rational explanation for our results that we'll really we'll for sure dig into. So I would like to open the floor for questions. Yeah.
I was wondering whether from your data you can construct a more individualized financial literacy measure in terms of, for example, whether they make regular credit card repayments or whether they miss some credit card repayments.
Yeah. So we'll probably look into some of the private literature too. Yeah, if it's bench using, let's say, are they making minimum payments, right? So versus are they making full payments and not paying interest? Yeah. So we can think about that.
Yeah, maybe something that kind of reiterates some of the point raised by the discussion about thinking about heterogeneity, so, and in particular the interaction with retirement accounts. So first, 2 things. I'm assuming that what you're seeing is your income after retirement contributions, right? So in a sense, you're seeing the money that's deposited in someone's checking account. So it's like the money that's deposited after you've saved in that really big instrument. And so I'm just trying to think when we're thinking about the marginal propensity to save out of wages, but you're looking at wages post-retirement contributions, then that kind of biases. It looks like you have low wages and you're not saving, but that's precisely because you saved a lot.
Yeah, so it kind of biases against finding a large propensity to save out of wages, right? Yeah, our data is after, so let's say 401k is probably the major retirement contribution that people have. It's after 401k. But if people kind of time before they file the tax return, they feel like, okay, we're gonna pay taxes now, let me throw $6,000 into my individual retirement account. I believe we should be able to observe that, but for us, it's probably just yeah. So for us, a challenge would be how to distinguish that from like regular fund flow to brokerage account, because like for me, it will be the same. I want to contribute $6,000 to Vanguard. Yeah, so that we should be able to see it, but we need to like identify how we can like tell this one is for IRA rather than.
And the second related question, very quickly. I think in the SCF, 80% of financial assets, like stocks, bonds, CDs, are in retirement accounts. At the median, it's 100%. So the number of people who have brokerage accounts is actually quite small. For most people, if you're not at it, and they have to be quite rich. And so I'm just wondering, so all of the action has to come from those people who are already at a tax limit and have these brokerage taxable accounts. And so how many, so maybe these numbers that look small are actually quite large because they only affect some small share of the population. And so doing some heterogeneity and focusing on the people who have brokerage accounts or are likely to use brokerage accounts would be helpful to kind of understand the magnitude of it.
Yeah, so you're saying, yeah, so people on top of like regular retirement accounts, they need to have, yeah, so that's our data requirement, they need to have an additional brokerage account. So.
Because the median person only invests in the stock market through retirement accounts. So you're not going to capture any sort of investment, and it makes sense for tax reasons. The only people who invest through these type of brokerage accounts are going to be richer people who are already at the tax limit on retirement contributions.
So do you think that's like some kind of a generalizability issue? Or?
If you have an effect of 4% increase in saving, but it comes from 10% of the people, then it must be that these 10% are increasing their saving by a lot, right? And so the magnitudes are very different. If 10% of people act and 90% do nothing versus everyone increases their saving by 4%.
But you require that they do have a brokerage.
So they,
So this is within people who have a brokerage account,
yeah,
right?
they have a brokerage related transaction in the prior year. So otherwise our sample
It's
is
already
too much.
within that.
Oh, so this, okay, then we have to think of these as,
Very, very
okay,
small.
okay.
But it's not conditional on them making that transaction within this tax refund period.
So that's not for our main analysis. So our main analysis just requires this individual to have some kind of brokerage related transaction last year, in previous year. But we do have a supplemental test where we only look at people who actually contributed after receiving tax refunds. And so for that, it's like they invested, but it's just a matter of how much. Yeah. Yes.
How do you handle dual holder joint accounts? So I think about a household with two income generators that go to work and bring a paycheck, and they both use the same checking account.
Yeah, we haven't thought about that, but so then I think empirically might be doable because then we can observe regular wage inflow from two different entities, right? So if they both have jobs. Yeah, for now we do not.
Yes, in that event, if they both are paid bi-weekly on the same cycle, you're golden. But if they pay bi-weekly on different cycles, it becomes a weekly paycheck that you observe.
Yeah, well, so this is I forgot some of the details. I cannot recall whether we required the regular wage to be from one single entity. So if that's the case, then we might have ignored the other entity. But then but I cannot recall the details. But that's something that we definitely need to look into.
Also, with the family being the unit of taxation in the US, that's also incredibly relevant, right? Because the tax code in Canada and many countries treats the individual as a unit of taxation, so individual level analysis is fine. But you're in an environment where the tax code, so you're trying to mirror individual level wage analysis with family level tax analysis, and you've got a discord there.
Yeah, great point. I realized that while I was trying to convert the after-tax wage into pre-tax, and then I realized, okay, so we need to make assumptions, and like most of the time it's probably mirrored filing jointly. Yeah, so that's we'll need to think about that as well. Yeah, thank you.
Awesome, thank you.